Welcome back. We're chatting to Collin Nefdt, who is an institutional asset consultant at Acsis. We're looking at the whole issue of passive and active investment. Collin, let's now move into the two, and let's try and see how we could structure a portfolio for an individual. How you would go about advising that person, what they should be looking for.
You know, again, themes on that have changed over time, but the current thinking that I really like is the general thing is people need exposure to the stock market and to shares to get the kind of growth that they need, for example, to retire comfortably. It's very difficult to save for retirement without having significant exposure to equities, because that's where the real growth has been over the long term. You know,
when you say exceptional exposure, and I'm a bit of a stickler for like percentages, and I know it irritates people sometimes, but when you're saying exceptional exposure, if I have, let's take a round number, let's say I have R1 million, what percentage of that should be in equities, do you believe?
if you're a long-term investor, I would say a minimum of 50%.
Okay.
Retirement funds can go up to 75% in equities, and that's a combination of local equities on the JSE and international equities. So let's just look at that range between 50 and 75 for a long-term investor.
So that's what the big guys are doing, that's what the small guys should be doing as well. Okay, right, thank you. At least we know now how much we should be putting into it. Now we've got to find out where we're going to put it and how you're going to split that 50%. You're going to take that 500,000, where do you put it?
A good approach for me, again, and that's embracing both active and passive management and saying both of those can coexist in a portfolio. I'm not somebody at the extremes who has to take a choice. I understand both approaches. They can work together in a portfolio for me. The approach is you need exposure to equities. Some low-cost passive make a lot of sense to get that basic equity exposure. Okay. The term that they use in our industry is beta. That's kind of exposure to the market. So it's saying, let me get somewhere around 60 to 80% of my portfolio exposed to the market in low-cost indexing. So I've got what I need, I've got equities, and I've got it at a low cost.
When you say those low-cost equities, what specifically are you looking at there? Would you be looking at things like the all-share index or Satrix 40, those sort of things?
Those will give you broad-based equity exposure in South Africa. There is a subtle difference between the two. The Satrix 40, again, as the name implies, is tracking the top 40 companies, whereas the all-share index is actually a larger index. It tracks a lot more stocks. So you get exposure to stocks which aren't in the top 40, but they're in the next layer. You kind of what they call your mid to small cap stocks, and sometimes there's very good performers in those sectors. So, it's best to actually track the total market. So I give a slight preference to an all-share tracker relative to a Satrix 40. Then you've got your basic market exposure in place, and then it's what do you do with the balance of the portfolio?
While we're talking percentages here, Collin, what sort of percentage would you allocate to a local exposure and an international exposure? Given that some of your local listings here are actually making their money internationally. If you look at your BATs and SAB Millers and those sort of stocks, they're making their money offshore.
Quite correct. That distinction in terms of where companies are listed is actually breaking down, because it's it's a global economy. And you're quite right, in SAB Miller, most of their revenues are coming from outside of South Africa. So even though they're listed here, yes, they're also listed in London, you've actually got to look at what they call the economic exposure. Where is the company's revenues coming from? So you can actually be listed, let's just say in London, and be getting most of your revenues from emerging markets. So it does make that distinction quite tricky. But at the end of the day, the thinking is that for South Africans, your liabilities or that cash flow profile that you've got to meet in retirement is in rands. So the thinking is have most of your assets in rands. But international diversification is very, very powerful, and there's a lot more opportunities internationally. So I believe you must always have some international equity component, but I don't know if you need to go more than 20 or 25%. You can still capture a lot of that global influence on the local stock market.
Two things that you've said which just made me think about instances. Firstly, it is very easy as well to buy on an international stock market. It's not a difficult thing anymore. It used to be, but it's very easy these days. But what you were talking about, where people actually, or where companies actually earn their money, I was having a conversation a while back with Adrian Saville, and Adrian was saying that you need to look at exactly that when you're doing international investment. He said, for example, his example that he quoted was Santander Bank, which was being hammered. Its share price was being hammered because it was a Spanish bank. But he said 90% of their income they make in South America.
Quite correct. Yeah.
So it's not even based in Spain. So he said you've got to look at those sort of stocks which are being hammered because of the European crisis. And he said you could pick up a very, very well-priced stock on a company that's making good money. I think another one he mentioned was BMW, because by next year or something, 50% of all their vehicles sold are going to be sold in China. So you've got to start, you've got to read, you've got to research.
Yes. And you can actually you can get some very good opportunities with the market saying, oh, this bank is listed in Spain, and the market could, if there's bad news around Spain, sell those shares down. And the smart stock pickers, the active managers, the guys can say, well, here's a good opportunity to buy a bank which has been unfairly kind of priced down, and give yourself an opportunity to buy something at a very, very low price relative to its business value. So i.e. a good investment opportunity. So that's actually where the active managers come in. You know, the passive managers, they've got to buy Santander in proportion to what it is in the index. But an active manager can say, hold on, everybody's afraid of Spain, but this bank is getting most of its revenues from Latin America. It's been sold down. Here's a good opportunity. I can make outsized returns by actually investing in this. So those are the kind of things that good active managers are aware of, where they can actually, if they get it right, can provide returns over and above the index with those kind of opportunities.
I know you guys would have to do a hell of a lot of reading and research and trawling the net and reading reports. I don't know how you do it, to be honest. But generally, your man on the street, do we read enough? Do we learn enough about the markets?
Yeah.
Or are we just the sheep?
That's a very good point. One thing about the investment industry is there's a lot of noise out there. Maybe I should say there's a lot of junk out there, because everybody's got an opinion on where markets are going.
Yeah.
So what you've got to find out is those sources of information that resonate with you. Is over time, if I need to read up on something, I've got a few sources that I will go to for what I think is insightful comment that works for me. So I think there's so much information now that we've got to discriminate. We can't go through everything. So I'm saying, yes, read more, arm yourself with more information, but don't just read everything. If there's commentators that you don't believe in, and that, don't waste your time reading that stuff. Find the stuff that really works for you, and that clarifies the investment industry and markets for you.
How do you then, having done your research, now we know, okay, I've already made my decision. I've got this R1 million, I'm going to take 500,000 and I'm going to go into equities. 80% of that is going to be local, 20% is going to be offshore. Of the 80% that's local, 60% of that is going to be passive, and 40% is going to be active. That's my choice. I've made it. How do I then find the right person to go and sit down with and deal with?
That's a very good question, and there's no definitive answer to that. Selecting active managers is a very tough task, and the thing that most people look at is the recent past performance is often what we call a contrary indicator. The guys who've done well over the last 3 years, research shows, do less well in the next 3-year period. So you can get caught up, and it's, we're hardwired to, we must choose guys who've done well. But there are many managers, they will move into that cycle where their outperformance will be followed by underperformance. But one of the things that we've seen a lot of market is there is persistence of outperformance. There are a group of managers who are able to outperform consistently. And what I found is those are managers that generally have a very, very strong belief system i.e. philosophy, on how money should be managed, and they have the conviction to actually carry that out. So I'm saying if you're looking for an active manager, it's kind of don't buy the fund and the fund's track record too much, kind of buy the investment philosophy and the investment approach of the fund manager. Align yourself to that philosophy, because most actively managed funds are going to go through periods where they outperform, and often those are periods of time where you need to just stay the course with the fund manager. Often people, as soon as they see underperformance, they want to sell the fund and buy a new one. Whereas underperformance is actually part and parcel of the active management journey.
But it's what we've said on this show so many times before. If you're going into this for the short term, you're doing the wrong thing.
Look, the short term exposes you to so many behavioral biases that you almost become self-destructive with your investment plans if you're short-term oriented. You're so exposed to the losses, you're so exposed to the noise that you lose track of that long-term focus, which is so essential. And if you found a fund manager whose investment philosophy you agree with, and you understand how they actually pick their stocks, and you can make that connection to the fund that is fairly solid, I'm saying then be prepared to tolerate, short-term underperformance, or even, slightly longer-term underperformance. Because what we've seen in the market is when good fund managers get it right, they more than make up for those periods where, that's correct. And I mean, we have some very, very skilled, high quality, I would even go as far as saying world-class active managers in South Africa. So we're not short of choice.
So it's find the right philosophy, stick with it, go in for the long term, make sure that your share allocations are set, you know where you're going, and then I suppose it's become a bit of a hackneyed phrase, but then just keep calm and
that's correct.
And bear the brunt, because there are going to be some storms along the way.
Yes, kind of save yourself from yourself, kind of thing.
I like that. Collin, thank you very much for coming in. We've run out of time, unfortunately, but it's been wonderful talking to you, and you've given us a nice structure. That's what I like. I like a bit of structure every now and then. That's all.